What is going on, everybody? This is Yes, I Read That, and today I am reviewing A Random Walk Down Wall Street by Burton Malkiel. A Random Walk Down Wall Street is another very different book. Usually I'm reviewing some fantasy or sci-fi books, usually just fiction books. And this book is completely different. It is about investing. It has a focus on the global stock market, as you can see from the title, on Wall Street and on the analysts that work at Wall Street. In my opinion, it's super interesting to see what these professional investors do with the money that, people always think like all the money in the world is in Wall Street, and it's very interesting to see, to me, just what these people do and how they're working. So yeah, this book is super interesting. It provides a very different perspective on the analysts working at Wall Street, and I found it very interesting. For some reason, these economic and business books really do interest me. I'm not really sure why myself. For some reason, I just find it fascinating to read what happens with money that belongs to really rich people and what these like Wall Street people just do. And I don't know, it's really interesting in my opinion. This book is also pretty famous. It's a very old book and it's discussing a very famous theory called the efficient market theory. So first I want to talk about the content of the book a bit and then give you my likes and dislikes and give you my score for the book. The content is very interesting. The main theory used to be that a monkey throwing darts at a Wall Street magazine could build a portfolio of stocks that would perform as well as one built by, or even perform better as one built by professional analysts. Does that sound interesting to you? Because it should. So first of all, the book is pretty well structured. It has 15 different chapters, all discussing their own topics in the context of this book. The first chapter introduces some basic theories of the market, like the firm foundation theory and the castles in the air theory. Those are basically explanations to what drives the prices of a stock. Because sometimes you hear people say, stocks are like a Ponzi scheme, it's like a pyramid scheme, it's financed by all the people that buy after you, which is just not really true because there are actual companies and you own a part of the company. So the firm foundation theory is basically that you try to value the company as best as possible and you try to find the perfect value, and if a stock is priced cheaper than this value you calculated, then you can buy it, and otherwise it's too expensive. And the second thing is the castles in the air theory. It's that people saying that if I buy the stock, I know there are people who want to buy it for a higher price, so that's why I buy the stock, which is basically like there is no real value attached, only like sentiment. Like if someone believes it can go even higher, then they will buy it for a higher price. So I speculate that someone will do that. And in this book, the author also calls it the greater fool theory, because you need someone else to be a greater fool than you, and this person needs to buy your stock. So basically, it's also a bit of an introduction to how stock market trading works, although I have to say, if I didn't know anything about investing before, then I think this would have been pretty hard to understand. But yeah, I found it understandable enough, so let's just keep going. In the next chapter, the author starts talking about some of the crazes and some of the huge bubbles that happened in the stock market. And actually, not only in the stock market. One example the author uses is the tulip mania or the tulip craze in the Netherlands, where people would just go out and buy huge amounts of very expensive tulip bulbs and never plant them, but just try to sell them to the next person for an even higher price. And it's pretty interesting to read about. The author emphasizes how weird some of the choices of the investors are, but this is 100% applicable to today's investments. I really like this aspect about the book. It's very old and it's a historical description of something that happened long ago, but all of this is still very relevant today. For example, the author describes how companies that would put a name with something related to robotics in their company name, they would shoot up in price. And that was in the huge robotics boom in the 60s and 70s. And it's the same. Like, I think last year blockchain was a huge hype, and companies that put blockchain in their name just shot up huge amounts. So it's exactly the same, still happening today, and it's just these older books that are still so relevant makes it very interesting and very attractive to read. But yeah, let's keep going. So the next chapter discusses the valuation of stocks in the 60s to the 90s, and the chapter after that discusses the valuation up until the early 2000s, and this is where a huge bubble appeared, and it was also called the dot-com bubble because this is where the internet appeared, and everybody thought that it's gonna become huge, and it did become huge, but just not as fast as they thought. So the bubble popped at one point, and a lot of people lost a lot of money. After this part, in my opinion, the most interesting part starts, and this is where the author explains two fundamental ways to analyze stocks. The first way is technical analysis, and the second way is fundamental analysis. He explains technical analysis in a very simple way. Basically, it is just looking at the chart of a stock and looking for certain signals that are buy signals or sell signals, and then acting on these. And then he continues on to say why it's not really working, and that he and a lot of other academics don't really like the theory, and he just kind of starts to trash it. And the next thing is he explains fundamental analysis, which is basically really evaluating all the income the company has, the future growth it could have, and making some estimates to how it could look in the future, and then basing your analysis on all the data of the company. He also goes on to explain that fundamental analysis is incredibly hard to do, and it's incredibly hard to predict the future of a company, especially if you go long term, but also in the short term, even for only 6 months. What I found very interesting is that he shows some historical data of what professional analysts guess and what is correct, and you wouldn't guess it, but a lot of these analysts he shows are actually very wrong. And I really like that he shows everything with historical data. Like, he shows the estimates and the actual reality, and usually it's just not matching up. So after talking about fundamental analysis and technical analysis, and having already said that technical analysis doesn't really work, he goes on to explain the random walk theory he has, which is basically explaining why technical analysis doesn't really work and why fundamental analysis is so hard and doesn't really work either. The main basis for his theory is the efficient market theory, and it's kind of hard to explain in very short terms, but basically it says that the market is efficient. For example, if I want to buy a company because it will grow a lot in the future, then the seller probably knows the same thing and will only sell it for a higher price. So if you compare that company that will grow a lot in the future to a company that won't grow that much, then it won't be a huge difference for me because the stock that grows more will cost more already. So the premise is basically that the differences between different stocks is usually priced in. A stock that is very risky usually has a lower price than a stock that is super stable and expected to give great returns. The interesting thing he talks about here is also that most professional investors fail at just beating the average market index over time, which is just really proving his point about technical analysis and fundamental analysis not really working. So for me, this was the very interesting part of the book, but this is not all. From this on, he drafts what he calls modern portfolio theory, which is how an investor should structure his portfolio, what he should buy, and obviously it should be an index of the whole market, and it should be greatly diversified, which he also explains with the efficient market theory. And it's interesting, but I don't really want to discuss it here. That would make for probably 20 other videos, and I'm sure you can find those out there if you really want to know about this. So let's talk about my likes and dislikes. I really enjoyed the main lessons this book provides. The first thing, and probably the most important thing, is that a portfolio should be diversified. In fact, at some point in this book it says that 90% of the risk, but only 10% of the returns that you can create with a stock portfolio lie in diversification. So yeah, while you can have greater risk and have higher returns, you know, you can be that lucky guy, it's just not worth it. The other thing that is huge in this book is that passive investing is way better than active investing, which just means that you shouldn't try and trade in and out of stocks constantly, and you shouldn't try to time the market when it's on a low, but instead you should just invest passively and let it ride out, and that's the better way to go when you look at historical data. Obviously, this also leads to the conclusion that buying an index is way better than buying individual stocks. So yeah, the main lessons are really solid. I also enjoyed that the book has a very scientific style. It backs everything up with historical data. It's very thorough and just really a good write-up. What I really think distinguishes this book from others is that it actually picks up some critiques on the theory, and some of them it instantly debunks, while for other critiques it shows that they're pretty valid, but that they can be explained with this theory as well. So, very interesting book if you're interested in the stock market overall. So, what were my dislikes? The first thing is that it's pretty heavy on maths and economics. It's pretty hard to follow if you haven't studied anything related to economics like me, and actually even the maths parts, it's not really that prominent, but it's just mentioned pretty often. Like, you don't need to know any maths, but still it's mentioned a lot. A lot of statistics in here, and that's coming from me who has a computer science degree where I was forced to do some statistics courses. So yeah, I certainly didn't understand everything, but I also think that you don't need to understand those parts. Like, the gist of everything you can really understand without any knowledge of math. The other dislike or negative thing I would say about this book is that it's just not good if you don't know anything about the stock market. Like, you need prior knowledge. As I said, I didn't study anything related to economics. I'm just kind of interested in the topic, and I learned a lot of new stuff, and I think, I don't know, I thought I knew a bit about everything before, but this was just more in depth than everything I read before, I guess. So yeah, overall, my score for the book is a 9 out of 10, just because I think it's probably one of the best books in the space. It is very scientific, as I said. If you're interested in the stock market and investing, I would say this is almost a must read. But the only negative thing I can really say is that it's pretty hard to understand and pretty hard to get into if you don't have previous knowledge. But yeah, if you read the book, let me know what you thought about it in the comments below. As I said, I can only highly recommend it to you if you're interested in the stock market. It has some valuable lessons. And yeah, that's my review. That concludes my review. So if you liked the video, make sure to drop a like and maybe sub to this channel. And I'll see you in the next video. Till then, bye!